Hey there, investors. Ever looked at a stock price and thought, whoa, that's one expensive pizza? We've all been there. Sometimes those big, pricey stocks can be intimidating. It's like trying to take a bite out of a giant pizza all at once. But guess what? Companies have a secret weapon for making those pricey stocks more digestible: stock splits. It's like taking that giant pizza and slicing it into smaller, more manageable pieces. Now everyone can enjoy a slice. Stock splits and their less common cousin, reverse stock splits, might seem complicated, but fear not. We're diving deep into the world of stock splits, using simple language and relatable examples to help you understand these market moves. So, buckle up, grab your metaphorical pizza cutters, and let's slice into this. Let's imagine your favorite company, Tech Innovation Inc., has been killing it in the market. Their stock price has skyrocketed to $500 per share. That's fantastic news for current investors, but it might scare away potential buyers who see that high price tag. Here's where the stock split comes in. Tech Innovation Inc. decides on a 2-for-1 stock split. This means that for every share you own, you'll now own 2 shares. But wait, there's more. The price of each share also gets chopped in half, down to $250. Think of it like cutting a pizza in half. You still have the same amount of pizza, but now you've got 2 slices instead of 1. The total value of your investment remains the same, just divided into more affordable pieces. So, why would a company go through the hassle of a stock split? It's all about making their stock more attractive to a wider range of investors. Remember, a high stock price can be intimidating for smaller investors. By splitting the stock and lowering the price per share, companies can attract more buyers and increase trading volume. Think of it like this: would you rather buy a whole pizza for $500 or 2 slices for $250? The choice seems obvious, right? Stock splits make investing more accessible, attracting new investors and potentially boosting the company's overall value. It's a win-win situation. Investors get a chance to buy into a successful company at a lower price, and the company benefits from increased demand and liquidity for their stock. Remember that tech giant we talked about earlier, Tech Innovation Inc.? Well, they're making waves in the industry with their innovative approaches and strategic decisions, but guess what? They're not alone in this game. Other tech giants are also getting in on the action, making significant moves that are reshaping the market landscape. Just like how you might split a pizza into slices to share with friends, these companies are splitting their stocks to make them more accessible to a broader range of investors. It's a strategy that's gaining popularity, and for good reason. In recent years, we've seen several high-profile companies making similar moves. Take Apple, for example. This tech behemoth has always been at the forefront of innovation, and their financial strategies are no different. In 2020, Apple announced a 4-for-1 stock split, making their shares much more affordable for everyday investors. This move wasn't just about making the stock cheaper, it was a calculated decision to attract more investors and increase market liquidity. And guess what? The move paid off big time. Apple's stock price continued to climb, proving that stock splits can be a recipe for success. The increased accessibility led to a surge in demand, driving the stock price even higher and rewarding both new and existing shareholders. Tesla is another example of a company that's embraced the stock split strategy. Known for its groundbreaking electric vehicles and visionary leadership, Tesla's financial maneuvers are closely watched by investors worldwide. Their 5-for-1 split in 2020 made headlines and attracted a whole new wave of investors eager to own a piece of the electric vehicle revolution. This move not only democratized ownership, but also fueled further interest in the company's ambitious projects. These real-world examples demonstrate that stock splits are a common practice among successful companies looking to make their shares more accessible and boost their market appeal. By lowering the price per share, these companies can attract a wider audience of investors, increase liquidity, and ultimately drive up their stock prices. It's a win-win situation that continues to shape the financial strategies of leading tech giants. Section 5. Flipping the script. Understanding reverse stock splits. Now let's flip the script and talk about the lesser-known sibling of stock splits, the reverse stock split. While a regular stock split is often seen as a positive move, making shares more affordable and increasing liquidity, a reverse stock split can be a bit more complex and is usually implemented for different reasons. If a stock split is like slicing a pizza into smaller pieces, a reverse stock split is like combining those slices back into a smaller, denser pie. This maneuver reduces the number of shares outstanding but increases the price per share proportionally. Imagine a company called Struggling Startup Inc. This company has been facing some tough times, and its stock price has been on a downward spiral. Their stock price has plummeted and is now trading at a measly $2 per share. This low price can make the company look unattractive to potential investors and even risk getting delisted from major stock exchanges, which have minimum price requirements. This low price can make the company look unattractive to investors and even risk getting delisted from major stock exchanges. Being delisted can have severe consequences, including reduced liquidity and loss of investor confidence. To combat this, Struggling Startup Inc. decides on a 1-for-5 reverse stock split. This strategic move is aimed at boosting the stock price and meeting the minimum price requirements of the stock exchange. This means that for every 5 shares you own, you'll now receive 1 share. While the number of shares you hold decreases, the value of each share increases proportionally. And yes, you guessed it, the price per share goes up proportionally, in this case, to $10. This can make the stock more appealing to investors and help the company regain compliance with stock exchange requirements. While a reverse stock split doesn't change the overall value of your investment, it can have psychological benefits. A higher stock price can attract more institutional investors and improve the company's image in the market. So, while it may seem like a simple accounting trick, a reverse stock split can be a crucial tool for companies looking to stabilize and grow. Section 6. Why reverse? Consolidation for a stronger stand. So why would a company choose a reverse stock split? It's all about consolidating their stock and boosting the share price to a more respectable level. Remember, a low stock price can be a major turnoff for investors, signaling potential financial instability or lack of growth potential. By merging shares and increasing the price per share, companies can improve their image and attract more institutional investors who might have restrictions on investing in low-price stocks. It's like putting on a fresh suit for a job interview. You want to make a good first impression. Reverse stock splits can be a strategic move for companies facing challenging times, allowing them to regain investor confidence and potentially turn their fortunes around. Section 7. Real-world reversals. Turning the tide on share value. Let's go back to our Struggling Startup Inc. This company, like many others, faced significant challenges that threatened its very survival. The executives were in a constant state of worry, trying to find a way to turn things around. Their reverse stock split was a bold move, but did it pay off? The decision was not made lightly. It was a strategic attempt to regain investor confidence and stabilize the company's market position. In the short term, the higher share price might attract some attention and temporarily boost the stock. Investors often perceive a higher share price as a sign of strength, which can create a positive buzz around the company. However, it's important to remember that a reverse stock split doesn't magically solve a company's underlying problems. The fundamental issues that led to the decline in share value still need to be addressed. We've seen this play out in the real world with companies like Citigroup. Their experience provides a valuable lesson for other companies considering a reverse stock split. Following the 2008 financial crisis, Citigroup's stock price plummeted, leading them to implement a 1-for-10 reverse stock split in 2011 to boost their share price. This move was aimed at restoring investor confidence and meeting stock exchange listing requirements. While the reverse split helped them meet listing requirements, it didn't erase the challenges they faced. The company still had to deal with the aftermath of the financial crisis and work on rebuilding its business. Reverse stock splits are a bit of a double-edged sword. They can create a temporary illusion of stability and strength, but they don't address the root causes of a company's struggles. While they can signal a company's commitment to improvement, they can also be a red flag for investors to proceed with caution and carefully analyze the company's underlying fundamentals. Investors should look beyond the share price and consider the overall health and strategy of the company before making any decisions. Section 8. Splits and you navigating the stock market maze. So what do stock splits and reverse stock splits mean for you, the investor? The good news is that both events are generally neutral in terms of your overall investment value. Remember, it's like slicing and combining pizza slices. The total amount of pizza remains the same. However, these events can present opportunities for savvy investors. Stock splits can create buying opportunities as the lower share price might attract more investors, potentially driving up demand and value. Reverse stock splits, on the other hand, require a more cautious approach. While a higher share price might look appealing, it's crucial to delve into the company's financials and understand the reasons behind the reverse split before making any investment decisions. Section 9. Keep learning, keep growing your investment journey. As you navigate the exciting world of investing, remember that knowledge is power. Stock splits and reverse stock splits are just two of the many tools companies use in the market. By understanding these concepts and staying informed about market trends, you can make more informed investment decisions. Keep learning, keep asking questions, and most importantly, never stop exploring the vast and dynamic world of finance. Happy investing! If you found this guide helpful, please like, subscribe, and share this video.